Are higher rates here to stay? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update and another roller coaster week for bond yields. By the way, I feel like I've been saying this in every weekly update in recent weeks. So, who says bonds are boring? In any case, Fed Governor Jerome Powell told the Senate Banking Committee this week that he and his colleagues do not need to be in a hurry to cut interest rates, given the strong labor market and elevated inflation. And the economic data this week seems to be proving him right. Here are the three topics that we'll be covering in today's update video. 1. How bad was the economic data this week, and under what circumstances might the Fed change its mind about rate cuts? 2. Which treasuries rose the most, and which ones fell this past week? And 3. What are the yield expectations for the upcoming week's treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? In this last section of today's video, I'll also be talking a bit more about the 30-year TIPS auction, as some of you have requested. And as usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. How bad was the economic data this week? And under what circumstances might the Fed change its mind about rate cuts? Here were the three economic data points that moved bond yields this week. First, the Bureau of Labor Statistics reported that inflation, as measured by the CPI-U, came in at 3% year-on-year overall, more than the market expected. The largest price increases were primarily seen in used cars, auto insurance, airfares, and yes, eggs. Egg prices soared 15% month-on-month alone and a whopping 53% year-over-year. We eat a lot of eggs in this family. A 60-pack lasts us about a week. So needless to say, we're not really excited about their prices right now. So eggs, used cars, auto insurance, and airfares. Some or all of these prices may stabilize or even come down again this month. But overall, the latest CPI-U report was taken by the markets as discouraging, reflecting continuing inflationary pressures, especially because the core index remains stubborn around 3.3%. Meaning that core inflation, which excludes more volatile food and energy prices, is even higher than overall inflation, even though core inflation excludes eggs and their massive price jump. The Wall Street Journal voiced their concerns as follows. Wednesday's report was particularly discouraging because housing and rental costs, which have been moderating and are expected to continue to ease, weren't the culprit. Instead, the latest report pointed to inflationary pressures across other goods and services that had seen a slowdown in price pressures recently. The unexpected increase in CPI-U pushed bond yields up in the middle of the week, which I know some of you benefited from, so congratulations to all of you who purchased at this week's 10-year T-note auction, which happened the same day that the CPI-U numbers were released. 4.632% is a nice yield. The second piece of economic data this week focused on wholesale inflation, as measured by the Producer Price Index, or PPI. The Bureau of Labor Statistics reported that PPI increased 0.4% in January, which, like for the CPI-U, was more than the market had expected. On a year-over-year basis, PPI inflation came in at 3.4%. CPI-U and PPI taken together show inflation coming in stubborn and hot at the beginning of 2025. Certain industry folks remain optimistic, though, because some of the items with the biggest price increases in January do not feed into the Fed's preferred inflation gauge, because the Fed doesn't look at the CPI-U or PPI all that much, but prefers the Personal Consumption Expenditures PCE price index, prepared by the Bureau of Economic Analysis, BEA, as their measurement, because it thinks the PCE price index is wider and better reflects the goods and services actually consumed by households. PCE numbers only come out at the end of February, but they are anticipated to turn out lower than the CPI-U at around 2.6% for last month. So whether this optimism about inflation being under control is justified or whether it's simply wishful thinking remains to be seen. I can tell you, when I look at my grocery bills and credit cards, I tend to err towards the side of wishful thinking. And the third piece of economic data this week had to do with retail sales. January retail sales data came in a lot lower than projected and caused some renewed concerns about the strength of our economy. This brought bond yields back down to earth a fair bit. And all of this happened against the backdrop of uncertainty around President Trump's next moves on tariffs, taxes, and practically everything else. And that's really the key, right? When we talk about whether higher rates are here to stay. The economy. Higher rates are here to stay if the new administration can maintain a stable or even growing economy and inflation remains stubbornly above the Fed's 2% target. Some market participants are even suggesting that under such a scenario, the Fed would even need to raise rates, something I wouldn't rule out in such a situation either. If the economy continues humming along and inflation starts edging down towards the Fed's target, then rates may come down gradually. But this does not seem super likely in my mind, given that inflation does seem to have stalled, and in some cases is even accelerating. Plus, the uncertainty and pushback around the current administration's plans add an additional element of economic uncertainty and inflation potential, as I already talked about. And the worst case scenario, if the economy enters a recession, if the current soft landing that we thought that we had achieved goes away, then rates may come down significantly and fast. What do you think? Are higher rates here to stay? Or do you see rates going lower this year? Drop a comment below and let everyone know. And let's move on now to where yields actually ended this past week. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Treasuries across nearly all maturities ended a bit lower than the previous week for all the reasons we discussed earlier, with the biggest drop seen in the 3-year T-note at minus 5 basis points. Only the 6-month was slightly up, and the extreme ends were unchanged. In the big picture, though, you could say that yields were more or less unchanged over the past week, despite a fair bit of volatility on a day-to-day basis. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black, and decreases in rates are shown in red. The 1-month, 3-month, and everything 3-year and longer are down, with the biggest changes to be seen at the extreme ends of the spectrum. Treasury yields across all the other maturities are slightly higher than where they started the year, with the 6-month T-bill up the most at 7 basis points. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. The 52-week T-bill and the first ever 6-week T-bill auction are also on the schedule. This 6-week T-bill was the 42-day CMB in a previous life. Check out this video here that we just did if you want more details on the 6-week T-bill and where you can buy it. If we scroll down further, we can see the 20-year T-bond and the 30-year TIPS will be auctioned off as well this coming week. Neither one is a reopening auction, so the coupon is still to be determined. At the time of this taping, here's what the coupon and the expected yield are for the 20-year T-bond auction on Fidelity's platform. And here's what the coupon and the expected yield are for the 30-year TIPS. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. For the upcoming TIPS auction, this chart may be useful. 30-year TIPS yields remain at some of the highest levels when compared over a 15-year period. At close of market this past Friday, the break-even inflation rate was 2.33%, which is a bit higher than the 15-year average of 2.14% and the post-COVID average of 2.18%. So, if the 30-year tips fits your timeline, goals, and expectations, and you want to add some inflation protection because you believe that inflation over the next 30 years will average more than 2.33% annually, which at the current time may not seem completely implausible in my mind, then this may be an option to consider dollar cost averaging into. 30 years is a long time though. As I always say, everyone's financial journey is different. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield, potentially. Here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one from Federal Farm Credit Banks at 5.86%, with a first call date in February 2026. Here's the CUSIP for those of you who may be interested. For corporate bonds, there's still a fairly decent list on Fidelity. Here's where the highest yielding new issues stand at the moment, with the highest yielding one from Bank of America at 6%, with a first call date in February 2026. Here's the CUSIP for those of you who may be interested. For brokered CDs, the highest yielding ones stand at 4.6%, all with first call dates in August 2025. If you know of any bank CDs or high-yield savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to build other sources of stable, predictable income in retirement, especially while bond yields are still quite attractive, then check out this video here on our beginner and intermediate level bond courses. And come join our next live member Q&A on Sunday, February 23rd at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 2, 5, and 7-year Treasury auctions and other new issue bond offerings. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.